Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Got a lot of things to go over, as always, but we're going to start off with, is a reduction in cardboard demand a warning sign of a slowing economy? We'll talk about that. Will the revenue from AI cover all the debt and expenses it created? That's a very interesting topic. We're going to run over that. And then also, too, some scrutiny. And I'm so glad to finally see this. Some scrutiny on private investments from the SEC. We'll go over that. And I think, Chase, you also want to cover a little bit on this small thing called the government shutdown. So we'll talk about that a little bit as well.
Yeah, I think we'll just start briefly on that. But before I do that, we'll talk about the companies we're going to discuss today. We're going to look at AutoZone, also to cannabis stocks. I'm going to say in the news. They have
cannabis stocks, really?
Yeah, in the news a little bit. We'll talk about that. So we're going to look at Tilray. I mean, obviously, they've been decimated. I'm curious if finally maybe there's a value opportunity there. And then other two companies we're going to look at are Starbucks and Wynn. As always, excited to take a look at the fundamentals for those businesses. But yeah, I mean, we didn't really do a long post on the government shutdown this week. And I'll tell you why. Generally, it's sounds like big news, but I mean, as you can kind of see, the stock market has had essentially zero reaction to it.
Well, yeah, it has. And actually, going back about 50 years, do you realize that the government shut down 21 times? I mean, I don't think people realize that. And it's not the big deal it used to be. It was the longest was December 2019, 34 days. But the average is only 8 days. And not much really happens for that. I mean, also your federal workers get laid off. They don't receive pay till they come back. Even the TSA workers, they could be kind of grumpy in the airport because they're not getting paid. They don't get paid. You know who does get paid?
The politicians.
Yes, the politicians do get paid. They get their pay no matter what. And it's just kind of disappointing.
And the nice thing is you're still getting your Social Security, you're still getting Medicare, so don't worry about those benefits going away.
Right.
That's not going to be shut down because of this. That's the big one. Post office, I know they're still functioning. I mean, there's going to be your contractors, your government contractors. I think those are really kind of the big ones that could have the biggest impact where maybe contracts get canceled. I mean, that is where, if you're in that profession, the biggest risk is, I believe.
Who has the biggest risk is actually the travel industry. Yeah. They expect to lose about $1 billion a week. Yeah, $1 trillion. No, $1 billion a week because, and I would not want to travel during this time because, again, TSA, you got your recreational parks are closed. There is just going to be a nightmare in the travel industry. And the industry itself is expecting, when you put it all together, about $1 billion a week in lost revenue, which they will get most of that back, but they are going to lose some things where people might say, hey, I can't go on vacation now because I missed my slot. So,
and I know the big one is like national parks. If you booked a trip to a national park, what do you do now?
Yeah.
You know, it's like, well, do I still go and hope that the government reopens next week?
Yeah.
And I mean, I'm traveling next weekend, but fortunately we're driving, so I don't have to worry about that. I know Harrison, he's flying next Friday, so
hopefully it's done by then. I was gonna say, let's you and I take a field trip down there and look at it, but let's use Harrison if it's still closed on Friday. Like, Harrison, take some video, let us know what it's like in the airports.
But, again, the big thing is just when you look at the government shutdown, the reason I think the market looks through it is it doesn't have a long-term impact on earnings. They know it will be resolved. It's just a matter of when it will be resolved. And there will be, Scott Bessent, the Treasury Secretary, said there'll be a small hit to GDP, and I think they kind of overplay it. It's like, it's going to hit GDP and cost us some. Realistically, it's going to be a small hit. Unless government shut down for 6 months, that's never happened before, and I don't think that that would happen.
Again, the longest I said it was about 34 days is the longest. And the other thing, too, is that when it does the worst because of government shutdown? Leading up to it. Those are the worst days before. After, it's like, okay, that's past news. Not going to worry about it because we know it will be resolved. They will get this resolved. We'll take, 4 days, 8 days, 30 days. It will get resolved, and the economy will continue on. There'll be bumps and hiccups, but it will be resolved. That's why it's not It's big news, but it's not really big news.
Yeah, it's big news, headline news, but the meat of it doesn't impact the day-to-day for most people.
I think what's more bigger news, and this sounds kind of strange, but the reduction in cardboard demand, we see it as a potential warning sign, one of many, of a slowing economy. Let me talk about that. The simple answer is yes, it is a warning sign, but it's also one of the many, many indicators that we are seeing. Cardboard is used in many items in the economy, from, think about it, pizza boxes, to multiple items you get delivered by Amazon, online, all these online stores. Most of them come in cardboard boxes. The numbers show that box shipments, after reaching record highs during the pandemic, are now down to levels not seen since 2016. And that's important. Not 2019 before the pandemic, 2016. So that's a big number there.
Yeah, and I was really surprised by this too. Obviously, the population's grown over time. So if you even look at it a per person basis, the numbers are just staggering, as they are down over 20% from their 1999 peak. And I wouldn't have thought 1999 would have been a boom time.
Right.
And I guess you have to also realize, people think about the consumer side of the equation, but not necessarily the business side of the equation. If you look at companies like FedEx, UPS, they've struggled a little bit, not because of the consumer, but because of the industrial economy. Yeah. So, they're still, ordering things, shipping things, moving things around, and likely using cardboard boxes. So, we've seen a little bit slower side of that business, which could be playing a part of it. The other thing, too, is companies like Amazon have reduced cardboard consumption by shipping some items in paper and plastic mailers. I know I get those all the time. And potentially even becoming more efficient in their packaging practices. I know we talked about this, and it's so funny because you were like, I feel like, many times they used to send a box inside of a box. And I was like, I don't think they do it as much. Kid you not, I got a package yesterday, and it was from, I think it was Pottery Barn. It was just picture frames. This giant box, huge box, all this air inside, and it had 3 other boxes. And then when you open those boxes, there was more boxes. And I was like, what in the world is going on here? I thought they solved this problem. Maybe Amazon has, but other companies haven't.
Yeah, I think Amazon has, and I think they're pretty smart with their money. Pottery Barn, didn't they file bankruptcy a while ago?
I don't think so. I think Pottery Barn's owned by
I thought
one
that.
Of the big.
Well, anyways, whether they did or not, obviously they're not very efficient with the box and the box and all the air. It's just kind of crazy what they do. But
maybe they do more. They're owned by Williams Sonoma.
Okay. But I think they bought them because I think
Yeah.
So, but the price of containerboard has been on the rise over the years, which can cause users of cardboard to reduce their consumption, except for Pottery Barn, obviously, as the price of corrugated sheets has risen 30% from 6 years ago to $945 per ton. I would not predict, based on this data about cardboard, that the economy is definitely heading into a recession. But I do think it is something definitely worth adding to the list to remember, and just put it in the back of the reserve there, thinking, okay, here's another thing that could be an indicator that we're slowing down.
And I just got to go back to my story. I'm like, why would they do that? When you think about it, you just said the cost for corrugated sheets is up. Well, what is the benefit of saying that? I come home from work and I see these big boxes on my front. I'm like, Taylor, what did you order? You open it, it's like, what the heck? I just don't know why a company would do that. Is it laziness in terms of packaging? Or it's like, oh, yeah, we got this box over here. I guess we'll use that one.
I think maybe it could be, in their mind, efficiency, because maybe they have a lot of big boxes. Yeah. And so rather than ordering a bunch of different sizes, well, okay, this is too small for this box, but it's big enough for this one. So could be efficiency, ordering less boxes, but it doesn't seem, with the price per ton at $945, I think I said, that I think you'd be wiser to be more efficient, like I think Amazon has become.
When I bet you Amazon's really dialed in. Obviously they have a lot of data. They use technology. I'm sure they know. Obviously they stock their warehouses kind of predicting what people are going to buy. They probably have the boxes in the warehouses predicting what people are going to buy too. Amazon, they're a great company.
Where's AI in that? AI should be predicting this. AI should be saying that box is too small.
I'm sure Amazon's probably leading the charge on that. But I would just add, too, that there are other warning signs, I would say, that the economy's slowing, not just the cardboard boxes. There was the guy from Fair Isaac on CNBC this past week talking about credit scores, and they were like, well, credit scores are really strong. Isn't that a good thing? He's like, well, it's not a leading indicator.
Right.
It's all based off past data. And he said he is seeing some cracks, and that's the big thing we keep talking about. The economy is okay. It's not booming, in our opinion. I'm not overly concerned about it, but there are some potential cracks that need to be watched.
And as they say, we say the economy's okay, but we're watching it closely in case it does start slip down more. That could be a problem. But let's move on and talk about, well, the revenue from AI cover all the debt and expenses it has created. And these numbers are amazing to me. AI is definitely part of the future, but has overbuilding surpassed the revenue that it can create. Think about that. When one steps back and looks at the numbers, they're just staggering. Over the past 3 years, major tech firms have committed more funds towards AI data centers than it cost to build the entire U.S. interstate highway system, which took 40 years to build, and these numbers are adjusted for inflation.
Yeah, I mean, that just blew me away when you think about that highway system. I mean, sometimes you're driving and it's like, gosh, it's just crazy to think that people actually built this system out, and you just kind of take these things for granted.
I think the concrete goes down like something crazy, like 18 inches or 2 feet. It's really thick concrete, not like 2 inches. It's majorly thick concrete.
Yeah, I mean, it's just an amazing system. So to think about how much money is being spent now on the AI side of the equation, it's like, wow. And I mean, if you look in the next 5 years, AI infrastructure spending will require, it says, $2 trillion in annual AI revenue. And if you think that's a lot of revenue, yeah, you're correct. In 2024, the combined revenue of Amazon, Apple, Alphabet, Microsoft, Meta, and NVIDIA did not hit $2 trillion. It is also 5 times the amount of money spent globally on subscription software. So, I mean, it's a huge investment these companies are making.
And we give these comparisons to let you know because, AI is going to be big. Yes, it will be. But when you put it in perspective, it may not be as big as you think to cover the cost. And the other problem, too, is consumers, well, they pretty much enjoy free use of AI, but it appears for businesses paying more than $30 a month per user, well, that seems to be the breaking point where they say that's all we're going to pay. AI executives claim the technology could add 10% to the global GDP in the years to come. With that thought, they are saying the benefit comes from where it will place a large number of jobs, and then that savings will be enough to pay back what they invested. But think about that. My question is, if you're replacing all these jobs, consumers, well, they're not going to have a job to pay for anything. They'll have less money, and they probably won't need or even care about AI if you don't have a job to pay for it.
Yeah, I've always wondered about that. I've kind of had this thought where it's like, again, all this investment, you essentially need to fire a bunch of people to make it worthwhile. You can only extract so much efficiency out of a person to generate more revenue to offset the cost. You need to cut costs to then actually benefit from it. But as you said, if AI truly is good enough to cover these costs, you're talking about a dire situation where 50% of the country is unemployed. And it's like, well, what good is AI at that point? So I always have questioned, to what extent is AI going to be able to, again, capture this huge investment? And there's many history lessons about bubbles that did not pay off because of the overexcitement on inventions. This includes such things as, simple as canals, electricity, railroads. People forget there was a huge railroad bubble.
Oh, yeah.
And also, too, you might remember the dot-com bubble where the internet was so exciting, the building of tens of millions of miles of fiber optic cables in the ground. The amount spent was the equivalent to about 1% of the U.S. GDP over half a decade. It was a huge investment.
And the experts, they like to have the justifications, well, from the experts, it was the internet. Well, they were saying, well, the use will double every 100 days. That's why we can spend so much money, because it's going to double every 100 days. Well, the reality was it didn't double every 100 days. It doubled about 1/4 that. About once a year it doubled. And the fruition of the traffic, when it was actually doubling every year, it wasn't enough to meet the expenses they had. And most of those fiber optic cables that you talked about, they weren't used about 10 years later because of what we have now called streaming. So they just sat there in the ground for 10 years. All that billions of dollars they spent, no return on investment till about 10 years later. And probably a lot of those companies that did that probably filed bankruptcy and were long gone by now.
Yeah, and I mean, I just can break that down, give you the numbers. The expectation was for doubling every 100 days. The reality was it doubled every year. Yeah. I mean, that's a huge difference, essentially. Yep. And that is, again, where you look at this is AI, again, not questioning, will it be around and will it be helpful? Yeah. But to the extent, are we overestimating its benefit? That is the question. And in fact, a report out of MIT said they found 95% of organizations surveyed are receiving no return on their AI product investments. And another study from the University of Chicago showed that AI chatbots had no significant impact on workers' earnings, recorded hours, or wages. And again, got to say, I still believe AI is here to stay. But again, that question mark that is in the back of my head, has the expectation gone too far?
Yeah, and we talk about the bubble. A lot of people talk about the bubble. And these are things that give you something to compare to, that these numbers don't make sense. And AI is here to stay. But is it over excitement of all this investment that they're just not going to return on it? I mean, we gave you many good reasons why we don't see that happening.
Well, the concern I have is there might be a company or two or maybe three that the investments pan out, right?
Right.
But other companies, they could have wasted hundreds of billions of dollars potentially on this investment, and they're not the winner. Those are going to be the companies that are going to get hurt. Other companies are going to file bankruptcy because they borrowed all this money and they weren't the winner. There was this gentleman on, I forget where he was from, but he was talking about you can't have 15 winners in AI. You're going to have like Google, for example. They were the big winner. Bing, Ask Jeeves, Yahoo, those all kind of fell to the wayside. They're still around, but they're not capturing the same profit level that Google is. It's going to be the same thing with AI, I think, 5 years from now. There's going to be somebody that is the big dominant player that's capturing the profits. Everybody else, they wasted billions, hundreds of billions of dollars.
And the thing that people don't think about is that a lot of this is borrowed money. Yeah. So if it takes, 4 times longer to get that return on investment, well, you still got to pay the interest on your debt. And the creditor's not going to say, okay, we'll wait another year. No, many times if they don't feel comfortable, they'll shut you down and say, we're closing that debt now. We want to get paid. We're going to force you into bankruptcy. So that's what happens. Can't pay the debt. And a lot of these companies are highly leveraged getting into AI. Very expensive. Let's move on to something I'm very excited about. Finally, some scrutiny on private investments from the SEC. The SEC has an investment advisory committee that was formed about 15 years ago that provides guidance to the regulator, the SEC. Now, recently, the committee approved a set of recommendations on how to deal with private market and protect, I love this, less sophisticated investors. The recommendation will cover the key problems with private investments for investors, which include how they come up with those valuations. Do you realize they come up with it themselves? There's no outside forces. They say, well, this is what we think it's worth based on this. Now, how unbiased is that? Not at all. That's terrible. And how complex. That's the other thing, too, that these are very complex, and they're not a liquid investment. I'm so glad that the SEC is looking at more of the sophistication of investors. And we have some great investors, but, they're doctors, they're attorneys, they're engineers, but they don't know a lot about investing because it's very complex, and it's just something they don't have the time to go into.
Well, I just think a lot of people, as you said, they're smart, but either they trust their advisor or they believe a salesperson. They get sucked into something. And, one client is a doctor. He came over 5 years ago now, and he had several alternative investments. And I told him, he's like, oh, I want you to manage the money. He said, I can't. I mean, we were able to manage a good chunk of it, but these alternative investments, I said, we can't do anything with these. These are really up to that company as to when they want to allow us to redeem them.
They're illiquid.
Yeah. We had one that, we got this notice and it said, hey, we're expecting to be liquidated by 9/30/2025, so a few days ago. I'm like, wow, that's great. Get an email on 10/1. So sorry, one of the real estate pieces did not sell according to plan. So we are now looking for alternative financing or ways to raise capital to make sure we can get your investment back. There's no timeline on when we'll get it. They said hopefully soon. I mean, soon could be a year, it could be 6 months. And it just is something that I don't understand why people do these things. And he was getting a fixed interest rate of 7%, 7.5% actually.
Right.
For me, taxable. Number two, why would I lock my money away for 7.5%? I'll take volatility all day long and get maybe 8 to 10% rather than locking my money away for 7.5%. I mean, it just makes no sense. So, I mean, I got to say, I think looking at this in so much closer detail is so important. And I do believe it was a wise move that the panel here, the advisory committee, recommended the SEC demand better disclosures, because that is something that most people don't understand, these pitfalls, the downsides to them. So the better disclosures hopefully help. And also, they said who can and cannot invest in private markets. And this was not just putting across the board. If you have a net worth of X amount, then you can invest in private investments. Instead, the recommendation was based on the investor's level of investment sophistication. So again, you got to understand what you're getting into before you sign on the dotted line into these things.
And I don't know how they'll come up with that level of sophistication, but it's something very important because there's many people that have millions of dollars, but they made it through something else, not through the investment world, and they can lose a lot of money because they don't understand private investments. And again, we say stay away from private real estate, private equity, private loans. I mean, all these, they're just terrible. And the SEC, this is an advisory committee, so I hope they do come up with the rules quickly before people find themselves in private investments that they just can't get out of and perhaps lose all their money. Today would not be soon enough for me to see that legislation passed. My recommendation is, if you're not in any type of private investments, don't go into them. Stay away, no matter how good your broker make it sound. And some are great salespeople. Remember, he or she is liking getting paid a big fat commission to put your money into these high risk investments. Say big fat commission. Sometimes it's not all at once. Sometimes it's a little bit up front, and then they get paid fees on top of that. I mean, the fees, and we've talked about this before about private investments, how high the fees are. I think they were like 2.5% to 3% per year.
Yeah, I mean, I forget. Yeah, like the internal fees from the private equity firms. Yeah, those are high, and the payouts to the advisors. Sometimes that's really unclear how they're getting paid. But again, they're not doing it many times. I think for the benefit of the client. I think they're obviously get some kickback from it. If they don't, I was thinking one other thing is you get again these false valuations. You almost get a bump up, right, in the valuation of that particular investment every year. It's like, wow, I get to charge a fee off this thing that's growing at a guaranteed 8% until you go try to sell it. You can't. Number two, or you sell it on the secondary market, it's worth nothing. So, I mean, short term, I think it's a very, again, short-sighted concept for advisors when they sell these.
These private investments have not been tested during a slowdown in the economy, and that's what worries me. If that happens, I think you're going to see a lot of storms, a lot of problems,
issues.
Yeah. So
yeah, and I think that the thing I look at too with these private investments is there's just so many concerns. And don't get me wrong, there's going to be some that work out fine.
Right.
There will be some that are good.
Some that will not. I think maybe a third.
Yeah, because I've heard, I did really well. And I was like, good, I'm happy for it. I've heard way more horror stories than good stories, and the risks are just so much heavier than I think the potential benefit.
All this information does come from our newsletter that goes on our website, smartinvesting2000.com. Again, smartinvesting2000.com. That's where you can sign up for it. Other topics we had that we didn't discuss today was looks like some investors are getting the message that the stock market is too high. Don't blame rising food prices just on tariffs. And Amex, I love this one, rises platinum card fee 29%. Is it worth it? I did the numbers. I will tell you, I like my 2% cash back active rewards from Wells Fargo. Easy. I don't have to do all this tracking that they have to now do with American Express.
I gotta say, you gotta go read that if you haven't, because I was blown away. I was hoping we were gonna do that one on the show today. I forgot to tell you.
We just don't have enough time. We need a 2-hour show.
But I was like, I couldn't believe the numbers. I was like, you're paying all these fees, and then the way that they calculate it, it's definitely worth a read. Again, it'll probably take you 20, 30 seconds to read it, but it's crazy.
All right, we got to do a company here real quick, Chase, before the break, and I think first up we're doing AutoZone. Is that what we want to do first? Was the
AutoZone?
Yeah, AutoZone was first on the list here. Let me get to AutoZone. Obviously, AutoZone's a auto parts company. Not much short on the float, 1.7%, 95% institutional owned. The P/E ratio, not a good start. It's at 29.1, above the industry at 24.5. Price of sales, 3.8, also expensive compared to the industry at 0.7. No price to book value, which means that their liabilities exceed their assets. Price of cash flow is expensive, 22.5 versus 8.2. And the PEG ratio does look good, 2.5. I say that because there's nothing for the industry. Now, the growth of AutoZone does look like, well, not very good. The earnings are down 1.3% over the past year. The industry was up 4.9%. We do see sales climb by 2.2%, better than the decline in the industry of 3.2%. The analysts do give this a 5-year earnings per share growth estimate of 12.3%, while the industry is at negative 4.8%. Maybe that's why it's got such high valuations. Disappointed here. They don't pay a dividend. I thought they would. The balance sheet, current ratio, kind of light, 0.8 versus 1.9. We also do see here that My screen just kind of went crazy. Debt to equity, again, no equity, so therefore there's no debt to equity. We do see net profit margin 13.6 versus 3.2. That's a positive. Return on equity a negative 64.5. I guess a loss or equity. Something's happening there. I'll try to look at the balance sheet, see if we can see it. And then free cash flow is $2 billion versus $1.1 billion for the industry. So what do you got going for it? Because I'm not too excited about this right now, Chase.
No, I'm disappointed. I was hoping we had something, because especially when you look at, the average age of the car on the road now is about 12.8 years, which is a record. So I either think, number one, auto manufacturers are going to benefit because people need new cars, or number two, it's going to be these part companies, because those parts are going to mature faster than the cars. So you either have to service your vehicle or get a new vehicle, which, again, that should benefit AutoZone. But, yeah, I mean, the numbers not looking good. I'll give you some here. The current price, $4,215.08. I don't like that. It's very hard to say how large of a price that is. Sometimes I wish this is when a company would just do a stock split, because it's so complicated.
How much is the stock price?
$4,215.08. 52-week range, $2,980.10. And the high here, $4,388.11. The stock, it's been a good performer, though, I'll tell you that. Over the last 10 years, it's up 477%. Over the last 5 years, 257%. Over the last 1 year, 37%. Year to date, 31%. So, I mean, it's been doing very, very well. But the big concern is you go forward on this company, you go out to August 2027, I see estimated earnings per share here of $182.45. Gives us a target sell of $3,028.67. This company is trading at 23.3 times those future earnings.
And I think we could be onto something with the car parts, but AutoZone is just too expensive. I did look at their balance sheet. I can't find a reason why they have the negative equity, but I go back to 2022. It was like a negative $3.8 billion. As of now, it's about a negative $3.9 billion. So they've got more debt than they have assets. Probably, I didn't take that quick of a look at it.
I did see they had something with financing on there. Okay. Again, I can't tell how large of a weight that would be on the balance sheet, but I did see something about financing in the summary. In their summary, they got a lot of stuff. It's kind of reading through.
They're not a franchise on those stores. Do they own those stores?
I'm not sure.
That could be a difference there.
Yeah, it could be.
Yeah.
So maybe the stores, and then also, again, that financing could weigh negatively on it. But it seems, obviously, it's not worth the research, because that valuation is just a little bit too high for a company like that.
Yeah, the debt is up $2 billion from just a couple years ago. So I'm not feeling good about this one. I think we got to find something else, because I like the concept, but AutoZone, too expensive, too much leverage.
Not in the right zone.
Not in the, ooh, good one. Okay. That wraps up the first half here. Stay with us. We'll be right back after these important messages. I'm Brett Wilsey with Chase Wilsey. Stay with us. Smart Investing Show. Be right back. All righty, welcome back to the Smart Investing Show. Before we get back in the show, we have a special announcements for the listeners of The Fan. Our last show on The Fan will be October 11th. So if you want to keep listening to the Smart Investing Show, go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. If you like to listen to the Smart Investing Show every Saturday, there are other ways to do it. Find that out at our website, smartinvesting2000.com, and you can listen to other places than The Fan, which 2 weeks be our last show here.
Yep.
We've been with them for 5 years, been a long time.
Yeah, but don't worry. Smart Investing Show is still going.
Smart Investing Show has been around for, I think, nearly 30 years, so it's not stopping, just changing the fan. So, well, let's talk about with our financial planners here, Harrison Johnson, CFP. Harrison, thanks for being here. This is something that doesn't come up enough, and we think, it's so easy. But I'm sure the local plumber out there, or the local doctor, maybe engineer, they just don't know when you sell your home, there's a way to keep some of those proceeds as opposed to giving so much of taxes.
Well, there's some nuance to it, because, if you sell a primary residence versus an investment property, there's different rules. So when you're selling a primary residence, you can exclude $250,000 of the gain component of that. If you're single, or if you file a joint tax return, up to $500,000 of that gain. And the rule is you have to have lived in that property and treated it as your primary residence. So you have to own and lived in that property for a combined 2 years in the last 5-year period. Doesn't necessarily need to be the most recent 2 years, just in any of the last 5 years, was that property your residence, your primary residence, for 2 of those 5 years? And if you can qualify for that, up to $250,000 or $500,000 of the capital gain component of that is then tax-free. So,
and it's so important to kind of look at the receipts and stuff. And I'm guilty of this. And I was thinking as I was reading this or reading this, I was thinking, gosh, I had this great guy, friend of yours, Chase, Nick Springer, do the pavers for me. What a great price it was. Do you think I kept that receipt? No. And I might call him and say, hey, Nick, can you give me another receipt? Because it was, I mean, I had a lot done. It was like $10,000. Those little ones add up over years, 10,000 here, 5,000 here. And these can really start adding up against to reduce the cost basis of your home.
I mean, that would save you $3,500 in taxes, just that receipt. So that's what that receipt
I'm
is
making
worth.
that phone call.
Well, but I mean, you still have like to get the appreciation on the property, but you know,
Right.
on top of that,
Yeah. So if there's a gain that exceeds, in your case, $500,000, whatever that gain is taxable. You know, federal, state taxes. So your point though, if you do anything to the house, any improvements, you want to keep a record of that, because if you do go to sell, and you know, with property values in California being as high as they are, those receipts might be worth it. So if you can get a federal and state deduction or increase of your basis on the property, it's definitely worth doing that. And a lot of people don't, remember, because I mean, we're all kind of maybe guilty of that.
And it's virtually almost any capital improvement you do. I mean, if you put in a new landscaping, all these things.
It has to be something that increases the value of your property. So a normal repair isn't considered a capital improvement. So
like air conditioning, if my unit breaks and you repair the air conditioning, that's not a capital.
It's not supposed to be. I've seen people do it.
but what if you improve it, where you go from just a regular air conditioner to a heat pump efficiency, to where you're actually improving that capital?
Maybe. I mean, if you can make the argument that it improves, this isn't tax advice, so I'd want to look at that. But the IRS definition is something that substantially, improves the value of the property. So, do with that what you will. But I've seen people write off everything. So,
what about a kitchen remodel?
Oh yeah, absolutely.
I mean, that's done a lot.
That definitely does. So adding square footage, adding room remodels to kitchen, bath, all of that stuff, pavers, redoing landscaping, all of that stuff you could say is improving the value. And you want to keep those receipts, because again, if the gain when you sell the property is greater than $250,000 or $500,000, that extra amount is reportable, and those receipts can help offset that. Also, to keep in mind, your mortgage or any loans that you have against the property have no bearing on the basis or the gain. Some people think, well, my house is $1 million and I have a $700,000 mortgage, so that means my gain's $300,000. No, your mortgage has nothing to do with the gain. The gain is what you bought it for compared to what you sell it for. That's your gain, and then that can be reduced by any improvements that you've done, like remodels and things like that. So that's your gain component, and then of that, $250,000 to $500,000 can be excluded.
Yeah, one thing I know we always talk about is, I don't think here, and people are going to disagree with me, but here in California, rentals are worth the hassle with all the risks and the low cash flow that's generally a result of it. And sometimes when people have their home and they're like, I'm going to turn it into a rental, I'm always like, no, you gave up $500,000 of tax-free money.
Yeah. I mean, a lot of people will look to do that. And technically, you could move out of your house, treat it as a rental for up to 3 years, and then sell it, and it still qualifies, because in that 5-year period, the first 2 of those, it was still your primary residence. But the exclusion then only offsets the appreciation that you've had for the life of that property. When you rent a house out, you start to claim depreciation, which is a tax benefit to go offset the rental income that you have. But when you then sell it, any depreciation that you've claimed is what's called recaptured, and that is taxed. That depreciation recapture cannot be offset by this exclusion when you sell a primary residence.
Yeah, to me, if you're selling your primary, I don't think I would. I mean, I would never do a rental here in California, but I definitely would never do a rental if it was my primary residence.
Well, that's another thing people mix up too, because with investment properties, that's where people look at 1031 exchanging and things like that. Because if you sell an investment property, you can replace it with another investment property through a 1031 exchange. So then you defer all of that gain into the next property, and there's some rules that you have to follow and everything, but you can push that gain into the new property. Where with a primary residence, you don't have to do anything with the proceeds. Whatever the proceeds you get, some people think you have to buy a new house with it. No, you don't. You can do whatever you want. So you can spend it, invest it in something else. It's either the exclusion for primary residences or 1031 exchange is for investment properties.
And this is where the fee-based planner is so important, because someone should, before they do anything, give you a call up, say, Harrison, I'm thinking about selling my home. What's going to be the tax consequences? And you can do that. You can give them all these ideas. Chase, you brought up an idea, maybe in California, not a good idea to rent your home out. I mean, so many things to have a conversation. That's the difference between a fee-based planner and somebody that's trying to sell you mutual funds. They probably just won't do very much.
An example of that is, we're getting close to the end of the year. A lot of times when people are thinking about this is because they are retiring and then going to be moving. So let's say you've worked all of 2025 and then you're looking at selling your house. Well, if you're selling your house in 2025, that potentially taxable capital gain is a part of this tax year in addition to the other income you had from your job. But if you're retiring, that means, we're almost to 2026. You're not going to have as much income in 2026, likely because you're not going to have wages. So if you sell your house, in January, now whatever portion of that gain, even if there is some taxable income that's in 2026, if you don't have a lot of other income, that taxable part of that gain could be in the 0% tax bracket in 2026, where it might be in the 15 or the 20% bracket in 2025. So the timing of how you do this has a huge impact as well.
Right. I want to walk back something real quick. I know we're going to move on to companies, but the only time I would say it makes sense to rent it out is if you move states. If you move out to, let's say, Florida, and then you're like, I've never lived in Florida. Well, actually, it might make sense to rent your house out for a year, just in case you hate Florida and you're like, I want to move back. You still have that 2-year grace period. That, in retrospect, would be worthwhile.
Yeah, because I think you said, Harrison, it's 3 years, so you can.
So it's of that 5 years.
Yeah.
So yeah, if you move somewhere for a couple years and then you decided to sell, great. If you want to move back, you could. In that case, depending on where the house is located, a short-term rental might be better. So you're not, you don't have quite the risk of tenancy laws and squatters and things like that. But yeah.
So I take it back. Rentals can make sense, just very rarely.
Got to talk to your financial planner that knows your financial situation first before you make those decisions. So Harrison, thank you very much. We appreciate it. Again, that is Harrison Johnson, CFP. He is the financial planner at Wilsey Asset Management. If you want to have a free consultation with him, give him a call at the office. 858-224-0004. Again, that's 858-224-0004. Or go to the website smartinvesting2000.com. That's smartinvesting2000.com. And you can send an email and set up for that free consultation. Well, Chase, you ready to do another company?
I'm ready.
I'm excited about this one because they've been terrible for so long that maybe they're turning around. I'm talking about Tilray Brands, which is a pot stock, which is still a pot stock. Their symbol is TLRY. They are in the drug manufacturing, specialty, and generic industry is what they are. Wow, short on the float here is 14%. That's pretty high. This is owned by a lot of individuals. Institutional ownership is only 10%. Wow. That means 90% of people own this Tilray themselves. We do see, unfortunately, no PE ratio versus the industry of 58. Price of sales 1.8 versus 2.0. Price to book value 1.2 versus 2.1. And price of tangible book value is 2.4 versus 24.6. That's pretty good. However, there is no price to cash flow and no PEG ratio. No earnings growth over the last year. Now, this is positive but disappointing. Their sales are up 1.1%. I say positive because the industry is down 11.7%. But still, to have growth on a pot stock seems to be pretty good for a change. The analysts still don't like it. They get a 5-year growth rate in the earnings of a negative 142, so that's not very good. Tilray does not pay a dividend. Let's take a look at the balance sheet. A lot of liquidity here. Current ratio 2.5 versus 3.1. Debt to equity very good, 0.2 versus 0.7. We do see that they have a net profit margin, not very good, a negative 266 versus a positive 3.9. Return on equity also not good, a negative 144 versus a positive 7.9. This is disappointing, and because I know they have a lot of cash that comes through. Maybe some of this is not accounted for, but the free cash flow is a negative 128. I believe that's $1,000 versus 1.7 million or billion for the industry. So that's not very good. So I'm not seeing anything great here unless you give me some great numbers going forward.
Yeah, so current price here for Tilray Brands, again, their ticker symbol TLRY. It's $1.62. And I mean, this stock's just all over the place. 52-week range, the low here, 35 cents, and the high, $1.88. Year to date, the stock is up 23%, excuse me. Over the last 1 year, though, it's about flat, and the 5-year return down 70%. Here's the fun one, right? This is why we avoid investing in hype. The all-time high closing for Tilray Brands, $214.06.
And I gotta say, this is very volatile. I don't know if you see it over there or not, but the 3-month return, did you see the 3-month return?
No.
234%. In 3 months, a lot of trading going on with the stock.
Yeah, I mean, it's almost a gambling chip at this point in time. And I say that because you go out and there's still no positive earnings for this company. You go out to May 2027. There are 6 analysts following it. So, I mean, it's a larger following than I would have anticipated, but it's a negative 7 cents is what those 6 analysts are estimating. So it's just, yeah. And at some point, I thought maybe there'd be something here, but the big thing that we always talk about is the illicit activity that comes along with this business. It's like, gosh, back in the 20s, you had bootlegging, right? But I just don't know if that is gonna morph into like an alcohol industry like we've seen with cannabis.
Hey, and I'm not an expert on pot, but I know you can grow your own. Yeah. It's like, why? It's just like a plant. Why would you not grow your own plant? I mean, is there any manufacturing that has to be done with it? I think a lot of people grow their own.
Here's something that I found interesting. So the reason it kind of popped up in the news was it looks like President Trump posted a video on Truth Social touting the benefits of cannabinoids for seniors.
Cannabinoids.
And I was like, what the heck is a cannabinoid? Cannabinoids are individual chemical compounds, while cannabis is a whole plant that contains multiple cannabinoids. THC is the primary psychoactive cannabinoid in cannabis. That's the high that you get when you smoke or do marijuana. CBD, on the other hand, does not have the psychoactive effects. So I don't know how many cannabinoids there are and the benefits and the downsides to each one of those cannabinoids, but I'm assuming the average person at home growing their own marijuana does not know how to extract the cannabinoids. So that's where maybe there is some potential benefit for this industry.
Yeah, because cannabinoids sound like they could be something that for us older people can relieve some pain. Is that what it's supposed to do? Maybe?
Yeah, because like there's a CBD oil. Like I've used that on my back before, and it is kind of relieving. So I know it's out there. Yeah. But again, how profitable is that, and how hard is that to replicate? I have no idea the science behind it.
Yeah. So I mean, I'm not going to say the industry is dead, because it's not. I mean, these things, they can use them for other remedies that would actually make you feel better.
Yeah, it's not just potentially for that person that just wants to smoke pot and get high. It seems like there is maybe some other uses, and if you can find those uses, and that's what Tilray is doing, rather than trying to compete against the home growers, maybe there is some potential here. But again, not as a value investment, no profits yet for this industry, so I definitely would not be looking.
Yeah, so the days of thinking about the old pot stocks, like with the Cheech and Chong days where they were drug heads, I mean, it seems like the industry is developing, and there could be something with the future here. Again, their balance sheet looked pretty good, so they could weather the storm. Should we move on to our next one, which is another, we'll call it drug, Starbucks with coffee?
Caffeine,
yes, Starbucks. They are in the restaurant industry as well. Much better situation on the short here. It's a 3.9%, 87% institutional owned. They do have a PE ratio kind of high, 37.5 versus 29.7. Price to sales 2.7 versus 2.4. No price to book value. Price to cash flow 20.1 versus 16.5. And disappointing, no PEG ratio here. I thought we'd have a PEG ratio, but we do not. Now, their earnings over the last year, they are down 30.2%. The industry up 2.2%. The sales for Starbucks up 1.4%, not quite as good as the industry, up 3.4%. The 5-year earnings per share growth from the analysts is a negative 160%, negative 18% for the industry. We do say they pay a dividend, not too bad. It's a 2.9%. I like a 3% dividend or higher, so they're getting close to that area. However, their payout ratio is 103. Is a payout ratio versus 61 for the industry. Taking the balance sheet, current ratio 0.8 versus 1.1. That's probably about our bottom minimum that we would accept. Unfortunately, no debt to equity. I think they have a lot of intangible assets on the balance sheet. We do see that the net profit margin is 7.2 versus 7.9. I thought that'd be higher based on what I pay for Starbucks every once in a while. And we do see return on equity of negative 34 versus a negative 474. Return on invested capital is better at 15.7. Free cash flow 2.2 billion versus 2.9 billion. Well, I'm going to keep my fingers crossed here. Going forward, we'll find something that maybe this could be a buy.
And I was kind of looking to, I mean, the debt to equity obviously is going to be hit because they do have franchises and they have company-owned stores. Company-owned stores, many times they're likely not owning the real estate, so they have the lease obligations weighing negatively on the balance sheet.
They do have franchises?
They do have franchises, yeah. I think that's why sometimes you see like 3 within a quarter mile of one another.
That doesn't seem like a very smart business person. Like, well, I'll open another Starbucks down the block here.
Yeah, I'm going to be different from that. Right. I mean, sometimes I guess like, there's inside like a Vaughn's or something and there's one in that same parking lot. I'm like, I guess maybe that makes sense.
Well, in the Scripps Ranch, you have one in Vaughn's. Mm-hmm. You have one, I think, outside about maybe 300 yards away. And then one across the freeway, maybe a half mile away.
It's crazy. And, I've never understood their footprint. I mean, caffeine, I guess, is an addiction. So, I mean, they are profitable and they have good sales. So, I mean, hey.
I can't drive a half mile. I got to get it right now.
I got to drink mine and then I need another one when I get the next half mile. But looking at the numbers here for Starbucks, current price, $86.42. 52-week range, the low here, $75.50. The high, $117.46. I mean, this stock has essentially been dead money over the last 5 years. It's down about 2%. Over the last 1 year, down about 10%. Year to date, it's languished, down 5%. So definitely below what most of the stock market has been doing. The problem is going out to September 2026, I see estimated earnings per share here of $2.66. That's a problem because we get a target sell price at just $44.16. Wow. I was hoping with this stock languishing, maybe there'd be an opportunity. I've listened to the CEO, Brian Niccol, talk, and I really like what he's doing there from at least his words. I don't know the actions because we don't own Starbucks, but the big thing he wants to focus on, and get this, service.
Service. That's something you don't get a lot of today.
Mm-hmm. He wants to make the coffee shops a little bit more homey and again, wants to make people want to come into Starbucks.
Right. And I do see the analysts are not buying it yet. I do see it's actually down. It was like $2.98 90 days ago, so it's down about 10%. You said $2.66 now, and they're kind of all over the board. The low estimate's $2.31, the high's $3.31. Again, like you, I like the CEO, but we've got to have, and they got, 35 analysts. I would like to see more analysts say, yes, I like the CEO, and he can make money. He can make this profitable or more profitable than profitable now. And I like the concept, but we got to get it on sale. It's just too expensive at this point in time.
Yeah, and the interesting thing about it this week, it got a small pop after they announced a dividend increase from 61 cents to 62 cents. So,
oh, wow. Let's get it right now. That's a more penny per, is that per year or per quarter?
Per quarter. So you get 4 pennies per year.
4 pennies per year. That's a buy.
Oh, actually, who uses pennies nowadays? But
yeah, I know.
But I was going to say, too, I mean, the other thing that I look at with Starbucks is, I think long term that the CEO, I think if it pulls back and maybe you give it some time and it languishes further, I think there could be a buying opportunity. You just don't know. But the other big concern has been the cost of coffee beans. I know has just been crazy. I mean, that could all of a sudden flip profitability very quickly if cost of goods do turn around. But I know we talked about this, a couple of months ago. I forget when it was, but there was no positives in sight for the cost of those beans turning around.
And I think they're affected by the tariffs as well.
I believe so.
Yeah, so you got the tariffs. And again, we talk about the tariffs. They will cause inflation one time. If they don't go away, it's going to stay the same, but it's still going to hurt their profit margins. And I just don't know. Starbucks has been around for a long time. I just don't know who does not know about Starbucks, and is that kind of flipping where like, okay, I'm kind of done with the Starbucks fad, but great service. And I still like a Starbucks now and then. I get that excitement when I see one, like, oh yeah, give me I think I like the Frappuccinos.
They got a good product.
Yeah, great product. Yeah,
great brand recognition.
Yeah, all over airports, every place. Yeah. So, all right, well, let's move on and let's talk about not a food or beverage, but Wynn, a casino, resorts and casino industry. Wynn is the company, Wynn Resorts. Symbol is WYNN. Float on the short side, only 5.7. Kind of low in the institutional as well, only 72%. I thought that would be higher. PE ratio is expensive for Wynn. It is 36.7 versus 25.5. Price to sales 1.9 versus 1.5. Once again, a company no price to book value, which means that the liabilities exceed the assets. That's not a good thing usually. And I don't think there's any franchising here with the Wynn. We do see
one thing that I will say
Sure.
is I looked this up. They do own. They have 5 properties. They own 4 of the 5, or actually one's being built. So they own 3 of the 4 that are currently standing, and they sold the property to I think it was Realty Income. So this hurts them in 2 ways. Obviously, if they have debt on their current properties, that's going to hurt the debt of the equation. And many times you don't carry like the Wynn in Vegas on the books. It is not worth what it is for somebody to buy that. So I'm going to say it's somewhat underscoring essentially the strength of that balance sheet potentially.
Right.
Because they might carry it on the books, let's say for, I don't even know what those would go for. Let's say $50 million, but actually you could sell it for $100 million.
Right.
Because of the way that it's carried on the balance sheet. And then if you sold that property, well, now you have, again, those lease obligations for the Realty Income. So it's constraining the balance sheet in a negative way that may not be so negative.
And that's a good point to bring up. And we do own a REIT that actually owns land in Las Vegas. And I'm pretty sure they have acreage outside the Caesars Palace. I think they said that goes for, I think it was $30 million a square foot, I believe it was. Ridiculous what it is. So your point being that what they have on the balance sheet on that building is probably worth far more than
on
what's
the
listed
market.
On the market, yeah. So important point. I'm glad you brought that up. Price to cash flow 10.2 versus 8. We do see their earnings, down 59.4%. Industry down 0.5. Sales did fall by 2.2%. Industry down 1.2. Gosh, the analysts, they're not very excited about anything here. They say the 5-year growth in the earnings are negative 156%. They do pay a small dividend, 0.8%. They use 28% of the earnings to pay that out. Look at the balance sheet, current ratio 1 versus 1.3. No debt to equity because of what we just talked about, carrying things at cost, not the probably the true value. Could be different if you looked at that a little bit better. We do see net profit margin 5.5 versus 5.7. That's okay. Return on equity a negative 86.9 versus 25.5. And free cash flow $743 million above the industry at $609 million. Chase, what do you got?
There's a current price here for Wynn Resorts. Again, their ticker symbol easy Wynn WYNN. It's $123.66. The 52-week range low here. Wow, $65.25 in the high, $134.23. The stock, while it's done, pretty well so far this year, up about 43%. I was surprised by this. Last 10 years, it's up just 65%. So before this rally, it was essentially dead money for that 10-year period. But going forward for the business, you go out to December 2026, see estimated earnings per share here of $5.87, gives you a target sell of just $97.44. And the interesting thing here is on Friday, the stock was down about 7%. The reason was, I guess there's a pretty big storm heading towards Macau, and it's during the region's Golden Week, which welcomes thousands of visitors. And I was like, well, how big is Macau for them? It's actually very large. The Las Vegas resort that they have there occupies about 36% of revenue. They then have Wynn Palace, which is on Macau's Cotai Strip. That's 31.5% of revenue. But then they also have Wynn Macau. That's 19.4% of revenue. So those two combined is 50.9. So half their sales is coming from essentially Macau. And their Wynn Macau is about a 15-minute drive from Wynn Palace. So it's not like it's far away. And they have Boston Encore, which is about 12%. And they're building a resort in, 50 minutes. It's from the Dubai International Airport. I was kind of looking at pictures. It looks crazy what they're
I'd like
building
to go
out
to
there.
Dubai, see what's in Dubai.
It looks very cool.
Yeah, I do believe that China, I think the Chinese are big gamblers, I believe.
I believe so, too.
And so that's why it's such a pain, because with that storm coming in, they're not going to travel to go to these places, and they're going to miss. What was the week again you called it? The
Golden Week.
Golden Week.
Yeah. And I was kind of surprised by this, but their revenue breakdown, 61% comes from casino.
Right.
And then about 16, 17% 13% comes from rooms, 15% from food and beverage. They do have 81 restaurants. And then around 7.7% comes from entertainment, retail, and other. They have 200 luxury retail outlets. So
What surprised you about that?
the casino, 61%.
Oh, no, that doesn't surprise me. I figure
wow.
that's where they get most of the revenue from, is the gambling side. That's why I don't gamble, because you're not going to win. The house is going to win.
That's why I think sometimes you go to Vegas, and if you don't gamble, you can get good deals on rooms because they just want you to come, and hopefully you gamble.
Exactly. Well, there's a closing bell. And before I do want to mention about fan listeners, this will be our last show on October 11th. So if you're listening to the Smart Investing Show, go to our website, smartinvesting2000.com. See where else you can listen to the Smart Investing Show. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Thanks for listening. We'll talk more next week right here on the Smart Investing Show.